Good morning, hello and welcome to Trading Hour. It is 11 a.m. and we are here with the latest. You can see behind us the color is still green, though the market's gotten a bit tentative with the shakeouts that we've seen over the last two sessions. Will today be different? Will today be the 25,000 mark on the Nifty? We'll find out soon enough. Just very quickly, I mean, there are a couple of heavyweights that are still dragging, keeping a lid on the momentum, though the Nifty is managing an 84-point uplift right now, and we're pretty close to the highs of the morning. The drags today include some big names like Reliance, Lever, Infosys, L&T. So some of your big boys, they're not letting the party really kickstart. But then you have the other side of the screen as well. Stocks like Asian Paints doing really well. You have some of the names like JSW Steel, NTPC, Hindalco, basically some of the old economy names that are having a decent session. Within technology, the trends are very split because if you look at the contribution, TCS is actually batting for the bulls on the upside. It's up about 0.8%. Tech Mahindra is not doing too bad, but Infosys is on the downside. So trends are a little mixed, all over the place. But the good news for the bulls is that the mid-cap index is really shining bright. You have almost 1,400 stocks advancing, less than 900 stocks declining. That's the index for you, 0.8% higher. So looking good. I'm, of course, Surabhi Upadhyay. As usual, with me on the show is Reema Tendulkar. Reema, I don't want to ask the question today. Let's just wait for it to happen when it's meant to happen, right?
All right, and let's also introduce in the show the management of Zaggle, because we've got a lot to cover in the next 1 hour on Trading Hour. Now, Zaggle reported a good set of revenue, a good set of quarterly performance. The revenues have gone up by more than 100% on a year-on-year basis. Raj N, the founder and executive chairman of Zaggle Prepaid Ocean Services, is with us on the show. Good morning. Thank you for joining in. This is Reema here. So, despite a more than 100% revenue growth, 112% to be precise, you're still holding on to your full year guidance of 45 to 55%. Why is that, and what is it that you expect in terms of the top line from Q2 to Q4?
Good morning, Reema. So I'm very tempted to, increase the guidance, but I will hold on till about Q2. The picture would become much more clearer in Q2, and then we will be able to, maybe up the guidance. But as of now, we would maintain, what we have maintained, which is 45 to 55% growth.
But there is a high likelihood that in Q2 you will be able to come out and raise the guidance. But is there some sort of a slowdown that you're seeing which makes you a bit conservative? I'm not calling you cautious, but conservative when it comes to your guidance, because on a quarter-on-quarter basis, your revenues have come down by about 8%.
No.
So is there some, yeah.
That is because of the seasonality in the business. Our Q1 and Q2 are typically 35 to 40% of the overall revenue. And Q3 and Q4, which is typically the H2, is about 60 to 65%. So there is no, revenues have not. So you always compare us Y on Y, because that is the real, way to measure it.
Okay, so on top line, you remain fairly confident, sir. Let's talk about the margin trajectory. As per, I think, our calculations, margins are somewhere around 10.7%. Tell us if you have any other number there. Now, compared to the previous quarter, again, if I look at, Q on Q, that's a big dip. It's almost 100 basis points dip. But year on year, obviously, the margin has improved a lot. So what is a sustainable run rate that you're targeting? Say, by the end of this year, where would you want your EBITDA margins to be at?
So the EBITDA margin, we would maintain in, low double digits is how, our estimate, and the guidance which we had given, would remain about in the 10 to 11% range. Revenues, of course, we are looking at, growing it at a higher speed than, what we have suggested. But again, we'll maintain, till Q2 and see how Q2 comes, and then we'll be able to give you a clear picture.
What are the margin levers that you're working with when you say that you'll maintain margins at 10 to 11%? Just take us through some of the levers that you have, the kind of tie-ups and the deals that you're getting into. What gives you that confidence?
See, but there are 4 levers to be very precise with you. One is the number of customer additions which we do. That is one. The second is the number of employees within the corporate who grows, as they grow. And the third is the amount of spend which they are doing. And plus the fourth is the new product Zoyer, which we have added. And so all of these are performing exceedingly well. Okay, and margins, if you look at it, compared to Q4, of last year, our margins have improved. in the Q1. Okay, compared to Q1 of 24 versus Q1 of 25, there is a little bit, but otherwise, margins Q on Q have improved.
Okay, got that. You've been actively talking about pursuing an acquisition. You've said that in the prior quarter, even this time in the press release, you're saying that in line with our growth strategy, which is doubling revenues in 2 years on an organic basis, the companies also focused on inorganic growth opportunities to enhance their leadership position. Where are we on this front, on the M&A front? Have you identified any targets?
So, so there are two strategies which we are following here. And the reason we do, acquisition is basically either, these are EBITDA accretive acquisitions. Second is they give us product accretive, or, they allow us to enter into a new geography. These are the three things which typically, are our drivers to do a acquisition. So, one, we will announce probably, let's say within 30 days from now, okay, which is basically not a very large acquisition, but a tuck-in. Okay, then the second, we are working on a large acquisition, but as you know, between cup and lip, there are slips. And especially, when you're talking to a larger company, there are a variety of reasons which you have to, cover for. And that's why, last time also I had told, Mangalam that about Q4 is when, the picture would become very clearer on this large acquisition. But we remain very bullish that we will be able to go ahead and do this acquisition.
Okay, so the inorganic route is open. You're growing organically as well. Just give us a target. It's a tuck-in acquisition that you're saying, but on the two important parameters, which is the number of customers that you're serving, corporate customers, and total users on the platform, what are you targeting by end FY25?
See, what has happened is, if you look at it, Surbhi, we have to go and do more of cross-sell, within our base. Our base today is about 3,100 odd, corporate customers. That's a very large base. Now, we have to spread them more so that, whatever more money we make from them, directly goes into our PAT or, improve our margins. So what we are seeing is that, across board, there is tremendous amount of requirements which are coming in for digitizing the spends. And the more and more we are entering into a corporate, we are finding, various different use cases to go ahead and, implement them. And across world is what I would say, companies have come out with a very clear-cut thought process that they need a bundled software, and, these companies which offer like one particular software and then another company comes in, provides another software is not the theory which would, say. Now people, more or less corporates, want a bundle, which is that, you come in and, you fix a lot of their problems related to productivity, cost coverage, as well as ensuring that, you give them a lot of transparency and productivity improvement.
We leave the conversation here for now. We look forward to hearing more from you about a possibility of a guidance raise, a tuck-in acquisition, and of course, even a large acquisition as the year progresses. That's Zaggle for you, also confident about maintaining margins at current levels. We will slip into a break. We'll come back and focus on the big story, and that's market regulator Sebi's sweeping changes to index derivatives. More on that on the other side. Welcome back. Sebi has released a consultation paper which proposes tighter derivatives trading rules to boost market stability and also protect small investors. Yash is now joining in with the key highlights from yesterday's press conference and the consultation paper. Yash.
Well, Reema, the intention through this consultation paper on derivative or F&O trading is very clear. That is to bring down the excessive exuberance and excitement when we talk about futures and options volumes. There are certain key things which have been suggested or proposed in the consultation paper to do exactly that. The first and the most important one is with respect to the minimum contract size. What Sebi has proposed is that minimum value of derivative contract on the futures and options side at the time of introduction of that particular particular contract to be raised to about 15 to 20 lakh rupees. And after that contract has spent about 6 months in the market, then to raise that minimum value size for the contract to about 20 to 30 lakh rupees. Remember, this currently stands at about 5 to 10 lakh rupees, which means there's a significant increase in the minimum contract value itself. The second one is with respect to rationalization of weekly index products. Sebi has suggested that weekly options contracts to be provided on a single benchmark index of an exchange. NSE has multiple indices where there are weekly contract or weekly expiry. Bank Nifty, of course, Nifty, Midcap, Fin Nifty, BSE has two, BankX and Sensex. Sebi has said that on weekly side, only one expiry can be taken and monthly expiries can be on the other contracts. Third one is with respect to increase in margin near contract expiry. Sebi has said that because there is excessive speculation during the expiry, closer to expiry, hence margins on expiry day and the end of the expiry day will be increased. At the start of the day before the expiry, extreme loss margins or ELM to be raised by 3%, and on the day of the expiry, they should be raised by another 5%. There are various other measures which Sebi suggested in its proposal, all towards bringing down the exuberance in F&O volumes and keeping retailers out of it. Stakeholders expected to submit their views by August 20th.
Okay, Yash, thanks very much. Let's see what the collective wisdom is on this. And we've been speaking to a lot of market participants. Let's actually bring in Nilesh Sharma, President and Executive Director at Samco Securities for review. Nilesh, good to have you on. I first want to start by understanding this whole business of reducing the number of products that are out there in terms of expiries, right? As our colleague was just pointing out, one day you have Bank Nifty, Fin Nifty, then Nifty itself. So does this mean that any exchange will offer now only one expiry in a week on any one product? What happens to all the other products immediately? And what's the immediate impact?
So this is just a consultation paper, so we will have to actually wait for the actual circular to come out, and only then it would have an impact and not an immediate impact. But obviously there would be an impact on volumes per se, because currently every single day of the week has an expiry, right? From Monday, Tuesday, Wednesday, there's Bank Nifty, Thursday, there's Nifty, on Friday, there is BankX. The point is that in other expiries, other than the benchmark indices expiries, the volumes are not so high. And because of that, there can be a trade which is due to the low volume, there can be speculative activities which can go against the retailers. That is what Sebi is trying to curb, so that the retailers don't get impacted due to the higher speculative activity. The only thing is this will have an impact definitely on the volumes. I'm not very sure how it will have an impact on the retail profitability, because if someone wants to trade either on Monday, he can take a trade on Wednesday. So I'm not very sure it will have an impact on the retail profit or loss, but obviously the volumes will definitely go down because of this.
Nilesh, the intent is very clear, but do you have any initial estimates of how the volume turnover might be affected, especially on the option side? For instance, I'm looking at an IFL note, and they say that although it is difficult to quantify the volume impact for all measures, our initial calculations suggest a 30 to 40% hit to the option premium turnover. Do you have any initial numbers to work with?
I think because there's no specific data, but I believe the impact would be in those lines only. Because instead of 5, there would be 2 weekly expiries. So there would be a 60% down on it. But obviously, some volume will shift from, let's say, Monday expiry to a Wednesday expiry of the benchmark indices. So there would be a little bit of shift in volume. And the loss would be in the range of 30-40% only.
What will be the impact, say, on a stock like a Bombay Stock Exchange? Do you have any numbers that suppose the turnover comes down by, if not 30-40%, because some volume may spill over to the other days, it comes down by 25-30%, then what will be the impact on BSE?
So comparatively, if you compare the two exchanges, this regulation kind of benefits BSE more, because they on Friday have an active Sensex expiry, which is where the maximum volume happens. But for NSE, there are other 4 days on Monday, Tuesday, Wednesday, and Thursday are the NSE indices which get traded a lot more. So if you'll see for NSE, it will be from 4 indices to 1 benchmark index. BSE, it would be status quo kind of. So I believe the hit would be more on NSE and not on BSE.
Absolutely, and that explains the way trade is happening today as well, right, Nilesh? Look at the BSE stock price. Let's pull it up. Yeah, it's there for you, 7% higher, and the market's really shrugging off this impact. In fact, a lot of the other brokers as well, stocks are all higher. Look at Angel One, 3.5%, Motilal Oswal, 361, IFL Securities. All broker stocks are also up and about today as we're looking at the result. The other aspect of this is, Nilesh, two things. One, they're saying that you increase lot sizes. Now, I've been reading some commentary that says that because of this, in fact, there'll be more participation on the option side. As the lot sizes for futures perhaps are going to be much, much bigger. So comment on that. Does that really defeat the purpose of killing speculation on the option side?
I believe so, because if you'll see currently there are around 50 in the June report of NSE, there are 50 lakh traders in the option market, but there are only 2 lakh traders in the futures market. So what happens is, let's say what happened when Sebi increased the minimum lot size from 2 lakh to 5 lakhs. Let's say I'm a trader with 40,000 capital. I want to trade in Nifty futures. I would have been able to do it earlier. Now, since the market lot went up, I cannot trade in futures because of lack of the required margin. The next best option, I want to speculate, I want to take a trade. The next best option is I'll shift to options. I believe even currently this can happen where if you want to trade a Nifty contract in futures, you need around 1.2 lakhs of margin. But if the Nifty lot size goes up from 5 lakhs to 20 lakhs, I'll need 4x, which is 5 lakh rupees. If I don't have that, intuitively, I will move to options. So I believe that can be counterproductive as well.
Exactly. That's what we were wondering, that, if you're trying to get people away from options, how does this work? But, to be fair, in order to streamline the option side of it as well, there are a lot of other steps that they're talking about, right? This whole upfront margin from the option buyer's point of view, that's one thing. Then they're saying don't, come up with too out of the money, deep out of the money options, because now the kind of strike prices you have, they have to be regulated. They need to be, within a certain band around the price of the underlying. So will these two measures, make options a little safer for retail?
I believe yes, because the longer the expiry, the lower the volumes, and because of that, the freak trades that we see happens a lot more in a low volume environment. So this will not curb the turnover, but this will actually safeguard the retail investor. I believe that is a step in the right direction, because there would be the volume would be shrunk, and the volume would be actually be more in the lower strike prices. The volume will go up in the lower strike prices, and that will actually help reduce the freak trades. However, I also believe that in long-term contracts, let's say a quarterly or a 6-month contracts, the longer the higher expiry should be allowed to actually hedge the position, because people generally hedge. There are a lot of strategies where people actually use for hedge also. It's not full-scale speculation as the regulators and others are more worried that full-scale speculation. But obviously that should not have an impact. The hedge and genuine turnover should not have an impact. The options margin, yes, to an extent that will also help in reducing the speculation activity, and that will also help the retail trader as well.
Thank you very much for joining in. Need to get into a break. On the other side, we'll put the spotlight on Maruti Suzuki and find out why it's buzzing in trade ahead of its Q1 numbers. Welcome back. It's a big auto day today because Maruti and M&M, both of them will be reporting their Q1 numbers. And by the way, on your screen is Godrej Properties Q1 numbers. Net profit of 520 crore versus 125 crore on a year-on-year basis. But let's get back to the auto space. Maruti in particular, Sonia is joining in with the street expectations. Sonia.
Well, thanks a lot for that. Today, big day for the auto sector. You have both Maruti and M&M that will be reporting earnings. Now, for Maruti, we're expecting a top-line growth of 7% to come in at a little over 34,500 crores. The EBITDA will go up by about 33% as per the CNBC-TV18 poll. The margins will improve to 11.4%, while the profit growth will come in at 31%. Now, the volume growth this time was quite muted. It was barely a 5% volume growth. That's because the small car segment continues to see a decline, while the big gainer actually has been the utility vehicle, or the SUV segment to be precise. UV segment volumes went up 29%, while the entry-level segment volumes were down 4% year-on-year. The EBITDA margins are likely to expand 220 basis points to 11.4% because of lower raw material costs as well as a low base that the company was dealing with. But if you look at it, for Maruti, the stock has done pretty well. The stock is up 24% in 2024 and a decent set of numbers expected today. Back to you.
Okay, thank you very much for that. We'll take the discussion forward on auto and all the numbers that we've got so far with our market fundamental guest, Devang Mehta of Spark Private Wealth Management on the other side.
Welcome back. It's still fairly quiet out there. Bulls not able to make too much of a headway. And the Bank Nifty is turning negative, as you just saw. So let's keep our eye out on that index as well. Devang Mehta is with us. He's from Spark Private Wealth Management. Devang, great to have you as usual. So let's start with first things first. This volatility that we've suddenly started seeing in the market. And even now as we speak, I mean, look at the slide that's coming in on the Bank Nifty. Does this cause any concern whatsoever? There is obviously this narrative of earnings slowing down just that tad bit. What's your sense?
Thanks, Surbi, for having me on the show. Always a pleasure to be on CNBC-TV18. So I think, I think very clearly what we feel is that the market is climbing all the wall of worries. If you look at the past events, the couple of months, I think, again, not that great an election result, right? A little lesser than expectation seat getting to the government, getting to the previous government also didn't make any difference to the fate of the market, right? So it was digested very easily and market started to rally again post that. And also look at the complexion of the market, that everything and anything has started to do very well. So a lot of sectors, again, I'm not talking about redundant stocks or redundant businesses, but companies which are exhibiting good numbers fundamentally on the macro front, on the micro front. I think most of the companies have done well. Come this month, the budget was also well accepted. I think, again, this is a clear complexion of the bull market that also forgets certain things which are not so great, right? The long-term capital gain, structure change, the short-term capital gain, I think the rise in STT, all of this are digested by the market right now. And I think we are in beautiful macro situation, right? From GDP growth to tax collection to almost every aspect to manufacturing. I think all the guns are blazing. The consumption, which was once a sort of a not so great story, all the levers are now in place post the budget. If things get implemented very well, I think the consumption side of the market will also start doing well. So yes, to answer your question, I think I'm not much worried. Might be a bit of earnings miss here and there will be seen in this season. But otherwise, I think liquidity remains extremely strong from the domestic side. Foreigners have also started to come back. Yes, on certain days, they have been big buyers as well. So the more of FOMO has been with them rather than the domestic investors. So I don't think there is much to worry. I think this markets can probably go on from here on as well in a good stride.
So you're constructive on the market, but Devang, this market has also been a bottom-up market where more money is made by picking the right stocks. So we've spoken in the past about how you've liked power themes, certain capital goods names, etc. Any fresh ideas that you have found interesting in the last 1 or 2 months?
Yeah, so I think, Rima, as you rightly said, we have been more bullish on the capex side earlier. So by capex, I mean everything, be it power automation, be it ancillaries. I think now what we are doing is we are getting into the proxy place to play this type of companies, and that has generally been our style. So while I talk about proxy, there are so many companies down the line without which the business is very difficult to even start, right? So when you talk about capex or when you start about setting up any plant, greenfield, brownfield, or even setting up a warehouse, there are sectors right from air solutions to air compression. I typically, I think I give an example of companies like Ingersoll Rand or Kirloskar Pneumatic. The industry size itself is just 45,000 crore. And these companies are 11, 12, 15,000 crore market cap companies. The size of the industry itself would probably grow by 7x, 8x in the next 5 years. You can just imagine these companies show around 35-40% ROEs. The profit and EBITDA are growing in excess of 20%, and the revenues are growing at say 15-18%. So these are type of companies which we look at. We look at companies into stamping and lamination. A company like Pitti Engineering, a company I talked about, like Ingersoll Rand. Again, these are not recommendations. These are some of the companies that we have bought for our clients and continue to do that. So these are, I think, interesting themes even in the capex place. Coming to the other side of the market, which was consumption, and I think it was a bit of I can say a laggard, the pre-budget as well as the pre-election results. I think that side also is now getting addressed. So we like a theme into tours and travel and tourism, which is hotel industry. I think the entire industry is seeing a demand growth of roughly around 13-14%, and the supply of rooms is around 3-4%. With ARRs going up, companies getting deleveraged, I think operational efficiency is coming to the fore and the business models changing. I think this side of the industry will also do very well if somebody has a 1.5-2 year horizon as well.
Okay, all right, Devang, that's an interesting thought. Today we are a little short on time, lots of earnings, so we couldn't have a longer chat, but we're looking forward to one once the season gets over. Thank you so much for joining in. So that's a take on the market and some ideas that Devang is working with. We'll take a break right now. On the other side, a discussion coming up on what RBI's new proposal on LCR, liquidity coverage ratio, could mean for banks. Krishnan Sitaraman of CRISIL Ratings will be with us.
Welcome back. The other big story which impacted the banking names is the RBI proposal of a 5% increase in the liquidity coverage ratio for banks to meet the cash needs of the digitally enabled retail customer. Also, it's eyeing higher liquidity for certain unsecured credit. This could hurt the profitability of banks. Krishnan Sitaraman, the Senior Director and Chief Ratings Officer at CRISIL Ratings, is joining us on the show now. Thank you for joining in. Your initial estimates, and have you done some analysis of which might be the banks most impacted?
Yeah, thank you so much for having me on the show. Good morning, everyone. See, the recent guidelines by RBI, or should I say the proposed guidelines, the objective essentially here is to enhance the resilience of the banking system to any form of short-term liquidity crunches or run-on deposits and so on. So our assessment is, if these guidelines were to be implemented as is, there would be an impact of around 10 to 30 percentage points in terms of the liquidity coverage ratios, or LCR, of the banking system from bank to bank. At a median level, currently we have assessed around 31 banks constituting more than 90% of the assets of the banking system. The median LCR comes down from around 136% to 117%. So that's the kind of delta, but the delta may vary from bank to bank depending on the extent of retail depositors so that they may have, the extent of granularity of their deposits, and so on and so forth. So essentially that is the kind of delta, around 19 odd basis points on a median level, but overall around 10 to 30 basis points. Around 26 of our 31 banks which we have looked at have do fall in that window of 10 to 30 bips. There are a few banks where the impact on the LCR is higher, but in those banks, even after taking the shave off, the revised LCR is still above 160%. So in that way, that does not have too much of an impact on their standalone liquidity profile.
Okay. Krishnan, just to take that point forward, is there a clear divide, I mean, PSU versus private, kind of a divide as to where the impact shows up more, or is it more granular bank to bank? And then which are the banks where you think they'll really have to quickly pull up their socks and build this LCR buffer?
Yes, I think that's a good question. That said, there is no major, I would say, difference on a category level. So as to this is the trend in public sector banks, or this is the trend in private sector banks, it is essentially varying from a bank to bank. It is also, as I said, depending on factors like extent of retail depositors, extent of granularity, and so on and so forth. The other angle here is the call that individual banks take as to what level do they want to bring back their LCR covers after the implementation of these guidelines. As I said, the numbers may come down, but it is still at a median level of 117%. It is still above the regulatory requirement of 100%. So it is possible that some of the banks whose liquidity coverage ratios have maybe come down, but still are at maybe 140, 150%. They may not want to take it back all the way to the previous levels. So that is a call that individual banks will take. But coming back specifically to your question, on an average level, we see the private banks LCR coming down by around 22% percentage points, and public sector banks around 20 percentage points. So on an average basis, there is not much of a difference.
Got it. So now, given what you just said, that most banks in any case are well above the regulatory threshold, so they may not rush to quickly shore up the LCR again, then why are you concerned about a potential impact on credit offtake and a further maybe impact on NIMs? These are banks anyway struggling to, move on deposits. And now if they start running to build up LCR, then maybe there's a business hit. But why are you worried if they're anyway above the regulatory threshold?
No, I would just like to rephrase. It's not a significant worry as such, but it is a trend. So when we look at the individual bank-to-bank variation, we see 17 of the 31 banks that we have looked at, after implementation of the norms as is, would have an LCR of less than 120%, as against only 3 banks in the universe which have such a ratio. And around 9 of these banks would have an LCR of less than 110%, as against none in the current dispensation. So some of these banks will need to kind of have a reasonable level of cushion above the regulatory minimum. They may not take the number all the way up to the existing level. That's the discretion that they have. But they typically, the banks tend to operate.
Oops.
When that happens, there are 2 things which will actually play out. So if you have to build up your high quality liquid assets to shore up the LCR, what that would mean is that the resources that will go towards that will not be available for credit dispersal, which means that the credit growth may be somewhat tempered from our existing projections of around 14%, which is again lower than the 16% which we saw last fiscal. And also, because of this additional amount being deployed in potentially low yielding investments, that can have an impact on the NIMs. We have already projected that the NIMs of the banking system will come down by 10 to 20 bips as compared to what we saw last fiscal. That could be somewhat more elevated this fiscal, depending on how actually these norms and the execution of those play out.
Okay, but this is going to be effective only next year, right? 1st of April,
that's right.
2025.
April 1, 25, that's right.
How much might the credit growth get impacted and NIMs? You've analyzed 31 banks. What would be the average?
So as I said, it is very premature to actually come out with some numbers, because the extent of impact will depend on the strategic decisions each banks will take. So now if the banks decide that they want to take the LCR all the way up to the current levels, then the impact can be higher. But as I said earlier, some of these banks may take the call that, okay, I will just take it up by somewhat a margin, but not all the way up to the earlier levels. So as I said, some of the banks who have had who will face a higher hit on the LCR are actually, even after the hit, having an LCR of 160%. So they may not want to take it up too much higher. So we will need to watch out for. And also the other dimension variable here is what are the final kind of contours of the guidelines which come out. Today, currently, it is a draft guidelines. RBI has sought comments on that. So once the final guidelines come out and we have some bit of visibility on the strategies that the banks will adopt, we can have a better handle on projecting the exact impact in terms of numbers.
Okay, we'll leave the conversation here for now. Thank you very much for joining in. Get into a break. We'll come back with more on the market. Stay tuned.
Welcome back. As we're all set to sign out of trading hour, let's talk about earnings, the big reactions that are playing out in the market. There are some actually very strong earnings that have come through, and these are the names on your screen. Look at the move on Torrent Power, 17% higher on what's been a blockbuster quarter. Gale's numbers have been very well received. A lot of brokerages upping their commentary and target on the stock, and Dixon also doing very well. But for all the winners, Reema, we also have some losers today.
And topping the charts on the way down is India Mart, reversing yesterday's gains as the street is disappointed with the fact that paid subscriber growth continues to remain weak. Collections have been lower than street expectations. Titagarh Rail, this is a stock which is up 50% year to date, but numbers are not adding up or matching up. Revenues for the company have fallen 1% on a year-on-year basis, and the stock is down close to about 5%. Johnson Hitachi is another one. Industars, add that to the list, down close to about 3% despite that buyback support. Well, at the index level, we continue to hold up in the green with a gain of about 70 points. Mid-caps continue to outperform, though in the last 1 hour, we did see the Nifty bank dip into the red. It's a wrap on the show. Thank you for watching.